Welcome everybody, and thank you to join this special event with Simon Campbell, round-the-clock trader CEO, and Adam Harris, a multi-account trader. Today, we will focus on one of the most important points for a trader: how to combine both fundamental analysis and technical analysis for our trading strategy. My name is Fabio Molfese, and I work as a business trainer for FinecoBank. Before going into details, let me give you some information. This webinar is registered. You can watch the replay from tomorrow in our video library. And I am also sending you by chat a link to book a demo session with one of our experts. So, guys, I give you the floor and let's start.
Okay, Adam, I'll just say a few words to begin with. Welcome. Good morning, everybody. Thank you for joining us. I can see a few of you coming in. Lionel, Stephen, good morning. Nice to see you all. Thank you for joining us on this webinar. We are live, so do post questions in the chat box as we go through. My name is Simon Campbell. I have been in this world of trader and investor education for 20 plus years, doing expos, seminars and webinars. You probably know me from the Round the Clock Trader online webinar summits that I host every month or two. And Adam, of course, has spoken on many of these events over the years. We're delighted to be invited here by FinecoBank. Today I'm a Fineco customer. I have the debit cards, the multi-currency cards, and the access to the PowerDesk platform, which includes your savings account and your investment portfolio and your trading platform. We'll have a look at all that stuff as we go through. We want to focus today on two forms of analysis for specifically looking at stocks, but also relevant to, I guess, the Forex and the commodities markets as well, using technical analysis, sometimes known as charting, of course, and the fundamentals, the data that the companies are reporting. It's the two tools that we have to enable us to find good buys from poor investment decisions. So Adam Harris is one of our chief instructors. He's been with me working for 7 to 8 years, I think now. Adam, I think it is.
Yeah.
In London. You've got a great story. I think it's always a nice story when I introduce a speaker, a trader who hasn't come up through the ranks working in a bank per se. You have run different businesses, you've had different careers, you sort of fell into trading with your own, to build up your own account after you'd sold out your own business, and very quickly sort of achieved a proficiency in it. You managed to find strategies that worked for you, and this sort of blossomed into a career of mentoring other traders and investors and friends. And I know you do some professional money management as well. So I don't want to go too much detail. I know you'll tell people a little bit more about yourself, but suffice to say, you're more than qualified to tell us how to do it. And today we want to specifically look a little bit at sort of combining fundamentals and technicals, which I think is something that you do yourself naturally in your own investment and trading strategies. So I'll hand over, so I don't want to take too much time. Adam, I'll hand over to you. And as I say, everybody on the webinar, let us have a question, anything that you don't understand, please don't be afraid to put it in the chat box.
Oh yeah, don't be shy. Thank you. Thanks very much, Simon. So first of all, I obviously want to do a sound check, make sure that everyone can hear me. I'm on the tail end of a chest infection, so I apologize if I have to clear my throat or I cough, but hopefully it's largely going to be behind me. And a couple of things I just wanted to add to that was, yeah, I think one of the biggest breakthroughs came when I always consider it luck. It's almost pure luck as to who ultimately influences you and kind of sets you on the path towards kind of finding stability in your trading. And it was pure fluke in a way that I was kind of referred through to a newsletter, which linked me through to a video, a series of videos that I would, there's subscription that I was following. And this is back in 2014. And the focus of the videos was really focusing on trending markets. And instead of this idea of, well, I have to be trading Forex or I have to be trading stocks, the idea was actually I should be focusing on the right types of liquidity and market conditions and opportunities within that. And it has sort of ultimately formed the basis of my approach to the markets, but also from that point onwards, what I did was I then learned how to identify a really good, strong trend. And conversely, because you know what a really good trend looks like, you know what a lack of a trend looks like. So that's kind of, that sort of brings us in a roundabout way to what the kind of the theme for today, where we want to be able to identify healthy stocks which have the similar characteristics. They all have in the charts. And so there's the next thing that I also wanted to kind of bring to the table is that in a way, technical analysis is really a reverse engineering of looking at something that has a good track record. So when something is trending, you can see all it really is we don't need to overthink technical analysis versus fundamental analysis. They're both two sides of the same coin. It's the same from a graphical visual representation versus
Adam,
yes.
could I just stop? Your microphone is cutting out intermittently. Just for a second, and then coming back. Could it be the battery, or is there?
I see it's okay. It should be good now. I'll keep an eye on it.
Okay. Yeah.
Yeah, it's
Thank you.
it's a good quality mic, so it should be fine. But I'll keep an eye on it. Might be me moving around or something. Excuse me. So it's the information we look at as two sides of the same coin. We're just looking at the same information from a different perspective, and that is something you kind of let go of. And so that's really kind of a theme that I want to bring through today. And there's a few other things that I want to talk about. So also, please don't be shy. If you have any questions, just put them into either the chat section or the Q&A. I'm looking left and right. I've got two screens, and so I've got you guys on video, on camera on the right-hand side, and the chat in the Q&A section as well on that side. Quickly talk about there's only really two states that any instrument, any time frame can be existing in. Excuse me, and that's either trending or not trending. So it's either trending or not trending. We want to be focusing on the state of the current market. So are we in a bull market? Are we in a bear market? What is going on? So we'll have a look at the charts. We're going to equally jump between the slide deck and the actual markets to do a real-time analysis. So first of all, just want to talk here about at what point a downtrend becomes an uptrend. And this is important because when we have a look at the markets today, are we in a bull market? Can we see at which point we shifted from bearish to bullish? Or are we in a bear market? What's going on? So here you can see the main thing really becomes about market structures, which are swing highs and swing lows. And you must also just keep in mind that before charts existed, you know, traders and investors were looking at price. They were looking at key price levels for, you know, particular stocks. And they found that if the market broke, you know, created a fresh low, then it was more likely to keep going lower than it was to turn around, and vice versa. If it breaks a fresh high, it's much more likely next to probably keep going higher rather than go around. And so what we're looking for is the behavior of the markets around these key market structures. And also, what do they have a series. So it isn't just a single move that tells us it's bullish or bearish. It's usually a series of moves. In other words, a trend. Okay, it's not just one thing that it does or two things that it does. It's usually a minimum of 3 or 4 things that the market does, which tells us that these types of things are it's a series of moves with the same sentiment. Here again, we can see when we go from an uptrend in the markets, which often provide a series of higher lows and higher highs. Once we start to test, the market then tests fresh lows, and we then, after that, subsequently produce a lower high. And then the next thing we do is create another fresh low. So in other words, we create a new low, we break the previous market structure, we then create another low. There are just a series of boxes that get ticked or a series of barriers that get broken that then tell us, okay, the market has become now more bearish than bullish. And at the same time, there are different ways in which we can do this. We can get a lower high and we go into a downtrend. And so you usually have to wait for the market to break a key level before you can definitively say it's a bull market or a bear market. All right. Then the next thing that I've added to the list here is using indicators. Really what happens is that if you choose to go the technical route, usually simpler is better. In other words, less information makes it easier for you to read, because first of all, many indicators are just replicating the same information. And so over time, what usually happens is, as you become more comfortable reading price action, and you're able to go down to the core elements. So what are the core elements? The core most important elements are price, first of all, because as we spoke about it, if the market is reaching new highs or new lows, the price level, testing it as resistance or testing it as support, all of those things tell you a lot about what price is doing. Then we can look at the quality of the trend. That's the price action itself. So when we say price action, what do we mean? We mean not just a single individual candlestick, but also the series of lows and highs and the overall quality of, say, the last 6 to 10 candles, or even the last 60 to 100 candles. What is actually happening there? And there's a story there. We know that if we combine that with the price levels, we can get a very, very good idea of whether the market is happy or not happy. In addition to that, we can use moving averages. Moving averages are very powerful because they can help us identify, first of all, really good locations for entry points into a trend. And they can also tell us if price is very overextended. So there's quite a few markets we can go look at now where price is a bit overextended. And therefore, if at some point it's got to have a correction. And so it's quite interesting because the concepts of technical trading are very, very simple. They're not that hard to learn. Where most of the difficulty that traders encounter or technical investors encounter is, ironically, is letting go of beliefs that somehow it's too simple. And this is a thing that we consistently go through, but somehow just letting go of other beliefs that we have that get in the way, that interfere with what we do. So we are very easily influenced by the media. The media is a big culprit in forming belief that we then have about the market. So a topic that's very topical to talk about right now, the US economy, which is the biggest economy in the world. It's the reserve currency, global reserve currency, and the economy is actually doing incredibly well, but the media is incredibly bearish. So a couple of things on that note is that the markets, first of all, the media is always bearish in the market when it's at its, even when the market has turned around and has become bullish, the media is still bearish. The media is never ahead of the curve and never has been ahead of the curve. It's never, but it sounds like it is. So
ignore the media.
100%. And the thing is that everybody thinks they've found their source, Bloomberg or Times, and they kind of, this is what's happening. And there's a lot of very rational sounding arguments as to why certain things should happen. At the same time, if that was really the case, we'd all be making millions doing that kind of thing. Everybody would do it at the same time. It doesn't really work that way, because for somebody who, for one person who's found somebody who, as a source they trust, that's bullish on the markets, somebody else has found somebody who thinks the sky is falling. And there's a lot of that stuff out there. There's a lot of the sky is falling and impending doom. And the thing is, unfortunately, you'll only really know that once you've been doing this for about 10, 15, 20 years, where you've been through. I came out of this in the 2007, 2009 global financial crisis. I remember all the junk that happened then. And then in 2011, they were still convinced that the next crash was still due, that the 2000, 2007, 2009 global financial crisis wasn't over yet. And then you just went through 2016, 2017, all the way through. And it takes a long time. And it's usually on the tail end of a bull market that eventually the bears are like, okay, it's a bull market. And then actually by that time, it's kind of getting tired again. And then eventually the market crashes. So generally, it just isn't constructive to do that. A lot of people miss out on opportunities. And so I want to talk about what are the technical signals, which are very reliable, more reliable than the media. So it's a big thing at the moment. I think we should also have a very casual discussion about the US dollar as a currency reserve. There's always that, it's not going to be the global reserve for very long, which is bollocks, which it is going to be. And there's all these kind of things. I mean, just using a recent example, there was a lot of fear a year ago, 500 days ago, when Russia invaded Ukraine, that everyone was absolutely convinced Russia was kind of going to wipe everything out. And now we kind of know Russia's just not as strong as they have claimed to be. And so that's a great example of propaganda and misinformation. So it's changed. The world is not necessarily the way that we perceive it to be, but also it's not necessarily everything conspiracy theories. So One of the tools that I quite like here to bring it back to this is to use the MACD. Is the sound still good? Sound looks like it's fine.
It sounds thanks.
Okay, so the MACD is a very, very good technical indicator. And so the best way to use this, again, is not using it as an oversold or overbought indicator. I have found, and most people, all the best traders I know, find that to be unreliable. And when we consider a tool reliable, it must be right 70 to 90% of the time. Excuse me, whereas oversold, overbought is a 50-50 thing. So it's just not reliable enough to be employed that way. And so generally speaking, the way that we would use this is as a momentum indicator, meaning that if it is trending higher in this sense, trending higher here, you can see on the, let's go and draw it, get my favorite tools out. If you can see that price is trending higher, you can also see that your indicator, which is either RSI or CCI or Williams %R or stochastics or MACD, any of those will do. If it is trending higher with price, then we are effectively bullish, because if that's bullish and that's bullish, then the momentum is very nice and healthy. These tools tend to measure the speed of the markets. Okay, they measure the speed of the markets now compared to what it previously did. So if it's trending higher, it's bullish. If it's trending lower, it's bearish. And it's just a very simple way to do it and very reliable. In addition to that is if we find that the MACD, for example, here is sitting above 0, which is over there. If it's sitting above this line, that's a little bit of an extra tick in the box that it's bullish. So if we have had a stock that has been going down for a very long time and then has started to trend up, and we notice that it is also now breaking. So this is bullish, and it's broken above that 0 level. Those are lots of little indicators that tell you that this has so we can use the MACD combined with price action, support and resistance to reliably give us clues. So in situations like this, and this was probably the toughest part of my journey, I would say, before I became consistently profitable. Almost all of the difficulties were me not wanting to commit to what the charts were telling me. So, for example, I would have gotten into my head that the market was bullish, and back then, by the way, there was always doom and gloom. There were concerns that Greece was going to default and Spain was going to default. This is now 2011, 2012, post GFC, as I said. There was going to be a trade war with China. There was all this massive, massive drama in the news. And most, if not any, none of that came to pass. And so we carried on. But in the meantime, the charts were consistently communicating what they wanted to do. So in a case like this, for example, I might have been convinced that the market is bullish and therefore it's not going to be rejected, but the MACD has become bearish. It is trending down. We can see prices battling with a level of resistance. And certainly a big, big clue would be that if we broke a key level of support here, if we broke that structure, which we do here, then that would say to me, okay, this is now likely to fail. And even further, the next clue that it gives me is it comes back up here and rejects that level and then carries on down. So in fact, there's multiple signals that occur here that give you all this information. The market is ultimately going to go the other way. So the MACD is incredibly powerful, first of all, at alerting a trader to when the trend is becoming exhausted and is likely to be expiring soon. Next, when the trend is potentially about to change. And finally, as well, when a new trend is potentially on the horizon, so where we get the beginning of a new downtrend. Okay, we get all of those. And vice versa, by the way, when we go from a bearish trend to a bullish trend. So then when we look at, here's another thing. This, again, I'm a big fan of, as you know, Simon as well. I'm a big fan of Warren Buffett, value investing, Ray Dalio. Big fan of Ray Dalio. If you're going to read anyone's stuff as well, I would recommend Ray Dalio's New. It's one of the most profound books on the history of economics and the cycles that occur. And although it sounds like it just is phenomenal. But it's for the average person to read. It's very good. He's written it for high school students. It's very, very good. And that will profoundly change the way economics. Excuse me. So very much influenced by traditional investors. Michael Burry as well from The Big Short. So I'm very much aware of that. But there's a couple of very simple things that you need to have. Keep in mind that companies that list on stock exchanges are supposed to be best of breed. They're meant to be thoroughbreds. They're meant to be successful companies as well. Will be companies that are generating, they want to make money when they list. That's their ultimate purpose. Build up a company, list it, take your money, get a payout, and then retire. Like, that's definitely one strategy. But other companies that's part of their journey. They're looking to get the money, they're looking to expand. People to expect every company to continue to grow. There's a point at which there's just no more market for them. They've occupied that entire market. And so we need to also understand that certain stocks are gonna, they're ultimately gonna run out of steam if there's no more room for them to grow. Understand kind of that's the basics, but it does mean that most companies that list, in theory, the stock market should be made up of companies that have the potential to grow and make return. They're supposed to qualify as they get listed. And then actually what happens is that in amongst those, you'll get the ones that really start to perform. But statistically, if you just bought a share from every single company that ever listed, the theory is that you'd be net profitable because most of those companies should list as a stock should, succeed. However, taking into account that we can certainly identify a company that isn't performing well. If we look at something, and this one here is General Motors, we can just see that actually going back for a very long period of time, this market hasn't really gone anywhere. It's very gappy. So gapping to me is a combination of either lack of liquidity or just a lack of faith in that. If the company can gap up or down on a frequent basis, there's a disconnect between the company's performance and the desire for people to own those shares, because when lots of people are buying shares, it doesn't gap as much because people are just putting their buy and sell orders in or buy orders in all the different levels. And therefore, the gapping doesn't occur on a frequent basis. And gapping to me is a sign, especially when it occurs frequently. It's occurring here almost on a monthly basis here, is not a sign of health. Then you look at something like Microsoft up here, which has just got a very strong, steady heartbeat and a general climb to the upside. And so the thing is, I'm looking at companies here that are producing these kinds of performance, not just over a 6-month period, but over a 10-year period. And so the big difference, what happened with Warren Buffett when he met up with Charlie Munger, was he taught him. He said, listen, you were messing around with all these pink slip companies looking for big moves on them. He said, actually, the best thing you could do is find companies that are already proven and then literally buy a great company at a good mediocre company at a very cheap price. And this is a mindset that I think still works today. The visual difference between a reliable, stable stock and an unreliable one. And people will choose General Motors if they get greater dividends. The problem with this mindset is that dividends improve with steady companies anyway. But the idea is that, look, there's thousands and thousands of companies out there. And if you just market cap size and then select from those ones, the ones that have the best trends, you are still left with hundreds and hundreds to choose from. So just by narrowing it or excluding it, or just saying, look, I want trending ones, is not a bad idea. That doesn't mean you're missing out. A lot of people, and this is where the gambling versus investing mindset comes in, is that they want to pick something, that's erratic, because if it goes up, then they make more money, as opposed to this being the closest thing you can have to a sure thing. If you can buy something with a steady weekly uptrend, for example, probability-wise, statistically, it's more likely to make you money in the future. It's already trending, it's already performing well. You do then want to get in. And so then the question becomes, where do I get in? And so I want to go through the live charts because I want you to see real ones that I'm waiting for myself personally to get in on. What's the time? We're good. Okay. So finally, yeah.
But can I is it fair to say that just on the previous slide, it says, use the charts for just the bottom left there, the price action reflects the short-term sentiment or speculation, combined with fundamentals for a more comprehensive view. So would you say that if you're looking to just trade on the short term, the fundamentals are much less relevant then? You focus much more on the charts?
Absolutely. And have to take it from me, you could take it from Warren Buffett or any of the others, where Warren Buffett will say to you, and this is what, not his exact words, I'm paraphrasing, but he'll say, for example, the day-to-day noise is something that you can ignore because the longer-term fundamentals will help the stock perform. So he's not looking at the stock price fundamentals, and he knows that ultimately that will play out. And traders, day traders, have the, again, it's two sides of the same coin. They're looking at the inverse of that. They're going, it's precisely why during the day they will, if a stock is looking bearish, just short it as a day trader, because they know that on any given day you might find a short-term opportunity, a pattern that's forming that just is only going to form for a few hours, and not necessarily allow their longer-term or longer-term bigger picture fundamental analysis to taint that. So it's, and there's a trickiness to that. You have to have a different hat on. So if you're going to look for day trading on stocks, it's probably better for you to not necessarily focus too much on the fundamentals, but to just look in the moment what this pattern is it bullish or bearish, and not be biased. Don't have a bias that's been created in the longer term views. However, on that note, I would say that if we're in a bull market, you generally don't want to short stocks too much, because stocks tend to go up more in a bull market, obviously, than a bear market.
What would you say when you presented with the Teslas, the NVIDIAs, even the Apple, but I mean, Apple's been performing well for years, but NVIDIA, take that for example, you know, it's shot up on the back of AI and all the technology. It's trading at sort of, I think it was at one point it's 40 times earnings.
Yeah, yeah.
It's really reaching into sort of bubble territory where everybody's just jumped on this, looking at the chart. So the fundamentals start to become the disconnect from the share price almost. So, you know, how do you take that? I mean, is that then, are you actually just taking a gamble because you've seen that so many people have piled into this stock? It's trading above its valuation, arguably.
Yes, your strategy is really the set of rules is that it dictates to you when, statistically, when a good time is to get out of anything, whether it's a currency or a commodity or a stock. And that's what your strategy rules are, because they're meant to put you in terms of probabilities and statistics on the right side of things. So technically speaking, we use moving averages. So now we're looking at NVIDIA here. We use moving averages here to tell us that when price is in the moving averages, that is, especially if it's an uptrend, statistically, that is a good time to buy. So when we look at NVIDIA as it is now, we know that now is not a good time. We know that it's far away from the moving averages, and therefore a good would be to wait for it to come into this part, or potentially in the past, you see it come down to the 50-period moving average down to here. So there is a major price level. Here is another major price level. So we know that getting in here or here is likely to be the next buying opportunity. Does that make sense?
Yeah, I can see that. I can see that.
So we use the moving averages to give us a sense of when the price is right, and when price is very far away from the moving averages, that tells us that the train has left the station. So I've done it in previous Fineco webinars where I've spoken about how the moving averages become a station and the price is the train, and we have to wait for it to come back to the moving averages before we would look for a buying opportunity. So we can, you know, we can argue about, and I don't mean you and me, I'm just saying people can argue about why NVIDIA is, you know, where it is right now, and is it overvalued? But technically we can see that it's very overvalued. And if we especially go and look at it from, we need multiple time frames. When you look at it from a monthly perspective, you can definitely see, look at its previous. So a couple of things we need to talk here about, and these are things that actually have more value for a trader or as an investor than a lot of fundamental stats. First of all, Warren Buffett himself said that there are two things that move a stock price. One is the actual performance of the company, its profits and losses and how it's doing, is it stable or not? And the second one is the perception of the value of that particular company, its brand, by the public. Do they care about it? Are they interested in it? Are they not interested in it? And so an example on that one, for example, if we go back, we look at Tesla. It's not an accident that prior to, here we go, so here is January 2020 over here. There we go. January 2020 is when Tesla took off. That's really where most people became aware of it, but it had a lot of history before that. Nobody cared about it at all. And this is where it kind of had a really big move from that point. So this is where the public decided Tesla was worth caring about and decided to get involved. So that's something to take advantage of. And this, of course, is where the public, at some point, there's no more people to buy. Smart people are generally going to take some profits. They might not sell all their stock. They might sell some of it because they can rebuy again at an earlier stage. So I just wanted to use Tesla as an example of where that's the first thing, is the public's perception of it gets it going. So you can almost certainly, as you see the candles get bigger, you can see this is where, this is where the public started to get involved in this. These are probably the early adopters. And the second thing as well, by the way, is just understand this. A lot of the money that goes into this is going to be either wealthy individuals or institutional money. I don't think anyone is going to argue with me on that. And institutional money are going to be buying for their clients on behalf, and they're usually going to be buying as a basket. So they'll buy tech stocks, their preferred tech stocks. So that'll be Tesla, it'll probably be Microsoft, it'll be NVIDIA, be Adobe or Autodesk, a couple of those ones. And so you must understand that when people are buying NVIDIA, the majority of people who are buying NVIDIA shares are not buying it as a focus. They didn't look at NVIDIA and go, I think this is a great thing. They bought it as a basket of tech stocks. So a lot of money that has gone into buying NVIDIA shares is money that is going into a big portfolio with a whole mix of other things and literally just being spread around. That's really important. You must understand that not everybody who was buying this was aware of the pending success of NVIDIA. They didn't know that. They didn't know that. They knew the probabilities were good that it were going to go up, but they didn't know it was going to go up exactly the way it has. And anyone who tells you that, statistically, it's unlikely. I'm not convinced. But from a technical perspective,
wonderful thing.
Sorry?
Hindsight is a wonderful.
Yeah, it is. But technically, you can. So I got in on NVIDIA in the early parts of this, and it's again, the process has been covered by me in all of our previous in our previous FinecoBank webinars, where we've spoken about it. So I'll give everyone a quick rundown of what the technical criteria are for going from a bear market into a bull market. It's been discussed before. I'm just going to recap for those who don't know it. So broadly speaking, when price is above the 50-period moving average, it's a bull, or at least for the S&P. Okay, if it drops below the 50-period moving average, broadly generalizing, sort of speaking in a general tone, it's bearish. So once we broke above the 50-period moving average, you could possibly go, okay, maybe it's bullish. But remember, at this point, most people are not convinced that the bull market is starting again. They just never are. And once you've been around for a while, you'll see. So I have the analysis, and you can see the point at which I start kind of saying, okay, we've gone bullish. And so you can kind of see it happen in real time as opposed to it being sort of hindsight. So not only that, we also broke through a level of resistance. We couldn't get through it here, couldn't get through it here, couldn't get through it here, but then we did. We also broke above that level. And so a whole lot of things started to happen. We've then got the 10 and 20 and the 50 in a bullish formation, and then the market took off there. So actually this area was a prime area to decide if you're going to buy. Not only that, but what happens here, MACD is trending up, it's bullish, and it breaks above 0. So I've listed a whole lot of things that happened that can't happen in a bear market. Let me put it another way. Those things cannot happen in a bear market. If it's a bear market, the market is not strong enough to do that, and therefore broke through it. Okay, so so it's very important that it isn't always just what we see, but it's what we don't see. And we have to ask ourselves, okay, if the market is truly about to crash, kind of what would we see? The next thing that I want to do, and I want to use I want to use a different chart for this. So to let's just see what we get for this one. I forget the 500. I'll do it this way. Go through the indices. We'll just do this one.
So this is the trading platform we're on, Adam. This is the new
FinecoX, yeah. This is great.
Charting package, but we also have fundamental data in the Power Desk platform, which is on the platform as well. So
It's it's the same information, but this platform is newer and younger and more powerful, obviously taking advantage of the latest kind of technologies that are available. So if we look at the S&P 500, which is a great starting point. So historically, again, this is where the history of money comes in. The Dow 30 industrial average was the very kind of first one, I think 1896 by Charles Dow, to create the titans of industry back then, which was an industrial era. And then over time, they've developed the S&P 500. And then between the Dow 30 and the S&P 500, they've extracted the best technology companies from there and formed the NASDAQ 100, sorry, the top 100 performers. And so because now we're more of a technology-based society than industrial, but once you put all three of them together, you get a really good indication of going back more than 100 years, 130 years of one of the most kind of successful companies there. Because of its size and its sample size is a really good indicator of what's going on. So the next thing we want to do is if we have a look at it from a monthly basis, so you'll notice I've got no moving averages here. I've just got the charts itself. We had a relatively good boom period starting from 2020 all the way through up till 2022. And you can see also, most importantly, the Anglo really strong bull period. And for every action, there's there's always a reaction within the market. So you have a big move up, you have a correction. The market's always got to breathe out and breathe in. And when it breathes in, what's happening is a lot of people, for every person who wants to get in to buy and hold, there's someone else who only wants to take advantage of the move. They want to get out or they want to short the market. You've got different people getting in and out for different reasons. Some people are just waiting for the market to correct so they can short it. Most people are different types of funds, mutual funds and so on are not. They're prohibited from selling. They can only buy. So you've got buy and hold institutions. And then often you'll have a correction when some people are looking to take profit from the moves up here. Some people are looking to buy as well. They've missed the move. So when we look at the price action here, you can see, first of all, that this angle starts to change. So when the angle, and this is where you can use, keep an eye on the time. When you have, let's just go with the segment at. And just kind of draw through it, you start to break through it. So a trend line is really used as just a general line in the sand to say when the market has changed its angle of momentum, because the angle is important. If it's going up like this, it's bullish. Then when it goes sideways, the momentum, the angle has gone this way. And when it goes down, it's gone bearish. So the angle of the flow of price is in itself a sign of the general mood. So this has changed down. So now we can actually this way, especially if we run along the top here, we could see that this had become bearish. We've now broken back up to that side. So that's another clue that we've started to become more bullish than bearish. But there's other little clues. When you start to look at price action, especially in these areas here, individual candlesticks, you can see that this low is not much lower. This candle's very bullish, but it can't break through, it goes down. Another bullish candle, this one tries and fails, but then you get another one that's bullish, and the highs are getting. Market is, there's a shift. Inside this, the market is losing sellers and gaining buyers. And eventually there's enough of a breakout here and a little bit of retest from the other side, and then it takes off. And once you've seen this over the years on 5-minute timeframes, monthly timeframes, your confidence, your faith in what it's about to do or what it's probably going to do next increases. Now let's bring on the templates. I'll bring on my one here so we could see this information with moving averages. And you can see the point at which the market kind of shift above the 50-period moving average. So even if you didn't want to count this period or count this period, once it broke above that one, definitely now, gone above or beyond that 50-period moving average. We've got a series of high lows. You've got an uptrend. You've got this trending up, you broke above the zero line here and you're still above it here. So there's lots of clues over, and this is a monthly chart, by the way. So this is over about 6 to 8 months. You've got a lot of clues that the market is trying to turn bullish. Okay, so the other thing that I wanted to mention here was when you go from a bull market to a bear market, so in other words, you're technically still in a bull market at this point. At this point, we're still technically in a bull market because we haven't really produced a lower high, lower low yet. when you go from that point to the point where you produce a downtrend, which if you want to argue is here somewhere, but if you really want to argue it's a break of this one, that point takes 6 to 18. So when you go from a bull market to a bear market, it takes 6 to 18 months. It doesn't happen quickly. People think it's going to happen in 2 weeks. It doesn't happen that way. It takes a long time. And it takes a long time to turn around. This took about 18 months or more to go from a bear market to a bull market. So when you listen in the media now and you hear about, oh my lords, we've got inverted bond yields, we've got this and we got that, and recessions around the corner. If we go by what's happened since the year 2000, that's not likely to happen. But let's discuss the possibility of, okay, let's say it is going to happen. Well, then we would need the market to start failing as it did over there. We'd need to see it start to slow down, and we need to see it start to crash, so to speak. And that would take months to happen. I'm not saying it can't, saying that it will still take months to happen. You can't go from a bull market to a bear market in a month. That has never happened before. And stock markets have been around for 300 years. So that's just something I want you to keep in mind. Are we due for a correction? And if we had a correction, where would the market come down to? Let's just say the market came down to here and then carried on. Would we still be in a bull market? Yes, we would, because here's our last low. And that could take 2 or 3 months, and we would still be in a bull market. And all the bears will be saying, that's it, the sky's falling, time to short the markets, and we'll still be in a bull market. So I'm trying to bring some sort of sanity to the moment that says how much and how long do things have to be bad for before we can actually say we're in a bear market, and what that would confirm this for us. Because what you hear in the media is definitely different from what the charts are doing, and I don't think anyone would disagree with me on that. There were a couple of questions. One of the questions that I know that was coming up was potentially, so what are my opinions on kind of what I think is going to happen with the interest rates at the moment with rate hikes in the UK and the US? So the reason that the US is kind of the global reserve currency, by the way, which is a massive responsibility to take on. When you do that, you are responsible for effectively the global economy, because everything you do impacts it. So you have to ask yourself, well, who would be willing to take on responsibility for the global economy at this time? And if you think the market's bearish now, you can't imagine anyone that would step up and say, yeah, we'll take over all of the potential dangers that lie ahead. So one of the biggest reasons why no one's going to move away from the US right now. Also, politically, become very polarized, whether you care about politics or not. There is a increase in anti-democracy stuff that's happening globally and pro-democracy. So the world has become divided on pro-democracy versus anti-democracy. Characteristics of anti-democracy, by the way, is propaganda, negative propaganda, which never adds up, confuses people. It's meant to confuse people. So I bring this up because now what happens is countries are not just looking out for the economic safety, but they're also going politically and their ultimate protection. Who do you want to align yourself with? We also know that militarily the US is the strongest military in the world. We know this. Although people are talking a lot about China, and even Ray Dalio, who I'm touting, talks about the New World Order, the hinting in the book is that every empire rises and falls. Every empire, the British Empire, the Dutch Empire, all of the empires rise and fall. And the implication from the book is potentially that the US empire is in its twilight stages. Now, actually, what he actually says is that, first of all, education is one of the ways to which to strengthen an economy. Because if you've got a strong middle class, it supports everything. And if you make sure that you don't have a wealth gap, you also strengthen the economy. All things that are currently being done in the US. They're really pushing for more education. They're trying to tax the less than 1%, the 0.5% of the population who benefited from the infrastructure. They're really trying to get that back down, and investing in the infrastructure is incredibly good. So you've got high unemployment, you've got education numbers looking good. So you've got all the things that, according to Ray Dalio, are the things you need to do to help to have a thriving country. Then you've got people that are like, no one wants to take on that debt. So although we've got a lot of rumors and a lot of misinformation going out there, think about what just happened in the UK with Brexit. Brexit is a nightmare, and there are still coming out of what happened with Brexit in the UK. There's no way that you now want to, on top of that, then separate from the US. So you've got people want to align themselves, especially with Russia potentially being a threat. They would align themselves with NATO because that is a good, sensible thing. They would probably decide to line themselves with the strongest military as well as the strongest economy. So right now, the US is easily the safest option, and almost certainly for the next 10, 20 years. The only thing that could ever damage that is if the US loses its democracy. That's what's under attack at the moment. And that's it. It's like, if we can oversimplify it, but that's ultimately what is going on. So to come back to the interest rate hikes, for anyone who's very young who's listening to this, when I grew up, which is, I hate to say it tragically, which was in the 80s and 90s, interest rates were higher. They were much higher than they have been for a while. And actually, the world has got very used to living with lower interest rates. And this is one of the key factors that led to the global financial crisis. Okay, that's one of the problems, was that interest rates were too low for too long. And so administration, and actually other countries will follow suit, is to try to get the world used to higher interest rates, meaning 5, 6, 7% higher. Now, there's a catch with that. It does mean, yes, it will curb inflation. That's a good thing. But it also means that the stock market might take a bit of a hit for now, but we've had thriving markets. If you go away and independently verify this, we've had thriving stock markets in the 70s and 80s and parts of the 90s, where we had high interest rates. We had treasury bonds, and stocks were performing well. It has happened. It can happen. It's not necessarily a problem. But I think a lot of people commenting on it today have forgotten. They're basically looking at conditions changing now, going back to that, and they're just going, look, we can't survive with high interest rates. It's not feasible. The thing about high interest rates is it gets people to less, or to spend within their means, is a better way of putting it. But the commentary coming out is it's getting people to spend less, which means that the economies are going to shrink. Not necessarily the case. It's possible that the markets are overexposed. The housing market, for example, most people will know, is overpriced. And part of that is because lower interest rates. So what we need is high interest rates to bring the housing market prices back down within reach of the middle income brackets and brackets. The second one being secondhand car sales. Secondhand car sales, at one point, that market was bigger than brand new car sales, which is ridiculous. And part of that comes from lower interest rates. So actually, this is a very, very good thing, even if it means it might be life might be tough for a while. So my impression, I'm willing to put some money on it, is that the US is going to maintain higher interest rates for absolutely as long as possible. They actually want that to become the norm, and I think other countries are likely to follow suit. This is going to be great for currency traders, because you'll get a bigger flow between lower interest rate countries or currencies and higher interest rate currencies. But you'll do that. Okay, so so that was my answer to that. I think that they're going to stay that way for years to come, unless there really, really is a big kind of market correction that we can't see. In order to reduce the deficit, sorry, because I know we've got a lot of topics we can talk about here, but in order to reduce that deficit, you need to collect more revenue. So more tax revenue is the biggest thing to get that. Where to get that money from is to collect it through tax revenue as a big part of it. And the second one I'm just blanking on right now. And both of those kinds of things, where the US, for example, is trying to employ more inland revenue people so they can collect that revenue. They've already had one of their best kind of scrapes, and then they can reduce their debt. So Ray Dalio's thing is to get out of the habit of printing money. The only way you can get out of the habit of printing money is to collect more revenue. If you can tax your billionaires, you can balance the books really, really quickly. Once you can do that, you can also obviously, you've got other kinds of things that you can do. So what I see that when I go through Ray Dalio stuff, for example, is all the things that he wants, if he was in charge, and Buffett and Charlie Munger, all the things they suggest that should be done are currently being done by the current US administration. So that's an amazing thing. And I think once that happens, I think other countries, the UK as well, for example, will follow suit. Excuse me. So I'm very optimistic about the future, despite the fact that there's a lot of doom and gloom. I do think that if something happens, if there's some kind of an iceberg that we're heading towards that we can't see, and this is the thing I've learned in the markets, is that the more people talk about an iceberg, like the year 2000, the concern about the IT bug in the year 2000, the more we can see something coming, the more people will prepare for it to avoid it. Our biggest danger right now is climate change, nothing else. Like, that's literally the biggest danger right now. And you know this because it's all over the place at the moment. So in terms of the markets, are we in a bull market or are we in a bear market? Well, if we go back to the platform and we look
Adam, sorry, you've just shown us the slides for a strategy. I don't think we talked about them though. Can we jump back to that? Because we've all been looking at these slides with the filters.
Yes, with this one.
Yeah, but we didn't actually get down to.
I wanted to say that, look, the beauty of this is it's built into if you've got a FinecoBank account, it's built into, you can use this to provide a example. If you want to get involved in UK stocks, or you want to have a look at European stocks, for example, you can use filters that you can build into this. There's a whole lot of amazing tips and other content that you can go through on this that will satisfy if you are very interested in this. It's available there, but you can also use a filter which is both a technical and fundamental filter on the platform, where you can go through, and then what it'll do is provide you with a list of stocks that you can then go look at. Now, what I would say is this, is that there's several thousand you can choose from, but you don't need to, once you've gone through them, which could take you a couple of days to go through them, you wouldn't need to go through all of them again a week later. It's very unlikely that if you filtered a stock out that performs badly, so if I go to the platform, excuse me, if I choose something that I'm not really impressed with, if I was looking at another one and looking at, sorry, I've got an itchy throat now. Sparkling water. For example, I had General Motors as an example. And then when you look at it kind of historically, you can ask yourself, if you filtered it and it had a nice amount of daily volume, and it had a big market cap, and it has a lot of history, you might say to yourself, I quite like this. And again, dividends, you can also use it to filter through dividends. So dividends, my analysis or my analogy would be that dividends can be seen as rental income. So if you bought a property as an investment, you want good rental income. But I would rather have a really good property, price property in a good neighborhood where I'm getting good rental income, than a company, a property in a dying neighborhood where the rental income is less and less and less, and eventually I'm going to sell the property for a loss. And so this is why I don't want dividends to become the primary reason why I buy a particular or invest in a particular stock. And if you work your way through, as an example, through Berkshire Hathaway's stock, let me see if I could just, where was it here? Through Berkshire, I had it on, was it on this side? Was it Berkshire Hathaway? So if I look and work my way through, I've got a list of all the ones that are currently, I think it's mostly up to date within Berkshire Hathaway. You could run through these, look at all the different stocks, and see what their charts look like. Even at that basis, I remember, you've only got a budget of so much. You can only either afford so many shares, or you can only afford to buy so many stocks. It doesn't necessarily. Peter Lynch is also another one, by the way, and One Up on Wall Street. So Peter Lynch, Buffett, and Ray Dalio, very, very good. There's some great content out there as well, where you can kind of pick up a sense of their techniques. But you might decide, you know what, I can only afford to put my money into 10 stocks, and therefore, out of Warren Buffett's 30 holdings, I like these ones the best, and those are the ones I can afford, and then buy into those. So it could be a balance of looking at stuff because of dividends, but for me, I would prefer something that has good dividends, but also I'd rather buy into 2 stocks that have good dividends than buying to 10 that are going sideways, because I'm not convinced that that's really, the longer term prospects are not as good. So, and yeah, so what else? We've got NVIDIA's doing well. We've got a couple of these. So again, looking at the S&P, and we can go and throw it up, mix it up with something else. Let's look at the FTSE. How's the FTSE doing? So the UK has had less growth than other countries in the G7. You look at it, not as big, not as strong, but also still, if we look at it from a weekly perspective, this is now not technically in a bull market because we are below that 50-period moving average. We haven't broken this low here. We haven't got a lower high, lower low. This level of support is holding. I would be a little bit more cautious if we broke that level of support, but I'm also not as worried because the US is also looking quite good. We've got my DAX, the German DAX, on a weekly basis. So here we are very much in a bull market, technically speaking. got a very nice bullish candle in the TradeStation, so to speak. We've got the 50, 20, and 10 in the correct order. I'm not worried so much about the MACD just yet. We there, but overall it looks good for now. So let me give an example of where I would be concerned is if I'll use this one. So let's just say that I'm looking here at this. So I would be concerned if price it is going to try and come back up again. If it failed again and started to break below that, so that's when I would start to get concerned. So you see multiple failures, you've got bearish divergence, and then you start to break through the kilos. That's really where that comes in. Again, this is a slow burning process. So if this was going to go, if we were for whatever reason going to have another bear market, which would be unusual, but let's say it's a possibility, we would need to start breaking the lows. We'd need to start going underneath the 50-period moving average and fail. We'd need to see it happen and then try and get back past it. We need to see all of that kind of happen. And so that would take a long time. It's not something that would take a week. It would probably take about another 2-3 months from now. So that looks relatively. Few others that can always look good. Here's the Russell 2000. So this is small cap companies in the US, and even this one is now looking bullish. If you look at it here, you can see it's looking nice and bullish. MACD's broken above that line. It's above the 50-period moving average. The 10 and 20 and the 50 are about to reorder and become bullish. So this is starting to look bullish. So small cap is about to start to break high. It'll have its breaks. It'll start to struggle at certain areas here. But this is about to start its new kind of move to the upside. And if we look at it from a monthly perspective, nice level of support here on a higher low. This looks like that's good to go up towards those levels. So actually, to me, when I look at some of these markets, I think we are potentially at the beginning of, like, we've had a good start, but we might be at the beginning of the next really nice big bull market. Let's have a look at a few of the others as well. So I wanted to see if Nikkei was here, for example, but I won't. I'll leave that. FTSE looks okay, but the UK is not really, and again, for me, and this is a personal preference, I would maybe look at individual UK stocks that are performing well, but the FTSE itself is definitely not viable as a as an investment. It just is not a performer when there's other stuff out there. There's so many other performers out there. So the Dow, for example, the S&P, and all of those are good performers. We've got a slightly higher low here. Once we break this, we definitely have a confirmed higher low, higher high on the Dow. So that is really the key level there, 35,000. Once we break above that, and yes, we'll then have to battle with this old call it 36,600. But we should be looking good. So again, we need to break out of that. If we broke below this level, then we might have something going on. And we're now in the second half of the year. So 2023 could also be seen as a bit of a consolidation. We've had a bear market, consolidation, which is 18 months to 2 years. And then we break out to the upside and we start the new bull market. So it could be the case. So just to recap, I think that there's more good out there than bad. I think there's definitely the media's ridiculous in terms of that. I think I mean, for example, one of the things that came up in my Twitter feed the other day was it was the US Treasury. Oh, I've just blanked on the word now. And it was basically showing a bit of a downtrend. The book was starting to shrink a bit, which meant a shrinking economy. But balance sheet, sorry, the Federal Reserve's balance sheet has started trending lower. And the concern is that that could be a sign of a recession. So you've got very low unemployment, which is not a bad thing. You've got them trying to shrink the balance sheet. Is that if you've got an ever increasing balance sheet, you actually are not in good shape. So the fact that it started shrinking, they're panicking now, saying that's not a good thing, but it actually is. You do want to get everything under control. And I think that's what's trying to happen at the moment. And again, these are clues. So the stock market as well is not necessarily a reflection of the economy. The stock market is made up of people who've got spare cash, people investing pensions, a lot of money going into companies that are looking to get cash injections. That's essentially what the stock market is. But it isn't necessarily a reflection, of the economy. It's a reflection of spare cash. Where is your cash going? Because if you've got money to invest, that's spare money. You're not using it, so to speak. And I think that's probably a better way to use it. In terms of employment, are people able to find work? I see tech companies are kind of cutting back a bit. I think it's probably better to pay more attention to anecdotal stuff. Are people you know being unemployed? Are you struggling to find work? You know, what's the cost of a basket of goods from the shops? There's a whole lot of things I think there are better indicators of what the quality of life is. And if they're not really bad, if people are finding work, you're able to get work, you're getting paid well, and the company's doing okay, then I think that's also an anecdotal good indication of the state of the economy. But there is, just to wrap up, there's just so much doom and gloom out there, ladies and gentlemen. Do not let it distract you. If you're not seeing it in the charts, it's not necessarily the case. So I'm sorry, I know I just rambled there. There were a whole lot of different things that we touched on, and I don't want to bore you with that, but yeah, there's some very powerful tools to do it. Remember that the reading for me would be, One Up on Wall Street is great because he talks about, if you love a product and you use it and everybody uses it, loves it, and that's Peter Lynch, One Up on Wall Street. Phenomenal approach. Joel Greenblatt's little book of Joel Greenblatt's got a really, really good one as well. Buffett gives you more traditional overview, and then I think Ray Dalio also gives you a big picture overview as well. There's some phenomenal. You can get them as audiobooks as well. They're just great for giving you a sense of, okay, I know what's going on. So,
Okay, Adam,
any questions?
Yeah, so fundamentals for medium to long term better charting for the.
I think we could. I want to see. Obviously, we go and hopefully Fineco will have me back on a regular basis, and then we can kind of, if it's starting to look bad, I will be the first to say that. And the thing is, I can tell you what I need to see. I need to see the market starting to fail, break lows, and then I'll be like, okay, that's happening. It's not happening right now, and so I'm not gonna say that. I'm not gonna doom and gloom it. It's just not the case. So
See what happens maybe when we get to September.
There we go.
A nice bullish tone. Thank you for that. Keep it all up. Great. Thank you everybody for joining us. Fabio, thank you for having us. Thank you.
Very good webinar, guys. Very good webinar. Thank you very much.
So we'll see you next time. Ciao. Take care.
Ciao. Bye. Ciao.
Bye-bye. Thanks. Bye.